Good evening and welcome to Boston University's Real Estate Club Guest Speaker Series, where conversations about real estate leadership management and people who have achieved something in our society. Today, we're honored to have Mark Gabbay here with us, the CEO of LaSalle. LaSalle is a leading real estate investment management firm and an independent subsidiary of JLL with $71 billion in assets under management. I'm pleased to welcome to this virtual room, Mark Gabbay. Good to have you here, Mark.
Thanks, Michael. Thanks for having me. I appreciate the time, being able to address your generation, because obviously I'm much older than you guys. I think, look, there's a lot of directions you can go with this conversation, but I will say before we get started that there's no question the real estate cycle that all of us are moving into here post-pandemic is probably the most unique of the real estate cycles that I've seen in my 35 year career. And I think most people also agree in the sort of uniqueness of this cycle. And there are a variety of drivers to that. But as a backdrop for those of you that are interested in real estate, I think whenever you have this kind of, hard fork in the road, perhaps it's going to create a lot of opportunity in this space, that even in areas that we're investing today, we don't even know what those opportunities might be, 10, 15, 20 years from now. So real estate's primarily kind of operated the same way for a long time. And I think the pandemic has forced some revaluation of that. And I think as you guys get into the market, you're actually going to be either the beneficiaries of that, or it's going to alter the space completely. So, that's where a lot of our conversations, I'd say, are today. But I think that's an interesting backdrop to just think about this, that by the time you get into the workforce, this industry could be very, very different, perhaps. And there's like bits and pieces of it going on.
Thank you. Well said. So let me give some background. I think it would be good for the audience to kind of get a good big picture as to what your career progression looked like prior to LaSalle. So after graduating University of California, Berkeley in 1988, you joined Hanford Healy Companies in 1989. Shortly after, Capmark Companies as vice president, and then you went on to join Lehman Brothers, where you co-headed real estate in Asia from 2001 to 2008. We're going to get into maybe some exciting stories or experiences there a little bit later on. I know a lot of us would love to hear about it. And then following Lehman, you went on to join Nomura Securities as managing director. But shortly after, you did have the opportunity to join LaSalle, which has gotten you more than a decade to today, where you recently became the global CEO in just January of this year, a few months ago, which is really exciting. You spent the last 2 decades of your career working in Asia. And maybe a good starting point, a great question to throw in would be, could you kind of tell us your experiences in working in that part of the world? And how does it differ from working in the United States?
Sure. I mean, first of all, when you listen to that, although it sounds like a fairly well-organized CV, I'll tell you it's pretty random at the end of the day. And a lot of those opportunities really came about for me for kind of being in the right place at the right time, and the door sort of opening and being willing to kind of take the risk and step through it. I mean, that's definitely the way that I got from the US to Asia to Japan back in 1998. I mean, when I first got there in 98, and I didn't know anything about the Japanese real estate market. I did not speak Japanese. I was not a Japophile in college like a lot of my classmates were in the mid 80s, because I mean, you guys don't remember, but back then Japan was kind of number one and everybody was studying the Japanese business ways in effect. So I didn't have any of that. So when I got there, I didn't really think I would be there very long for those reasons, which made total sense. Don't speak the language, don't really know the market, but ended up being there for more than 10 years. So, things can take these different paths. I mean, there's a lot of differences between the US and Asia. I mean, some of them are obviously are obvious. You got language issues, you got cultural differences. But for as many differences as there are, there's really a lot of similarities, especially when it comes, to real estate at the end of the day. You're still talking about, what we do, obviously in simplistic terms, is just buy and sell a building. And that's still the same, over there. Everything around it might be different, but the transactional side is the same. If I had to summarize kind of what the main differences are, is you can't underestimate kind of the cultural influences on business, broadly speaking. So I know a lot of people who came from the US to Japan in the late 90s with a very US centric way of doing business. And it didn't work in terms of really being able to understand, that culture. So, I mean, to me, working in Asia, was, first of all, just because there's so many different nuances to it, was really interesting. But more importantly, being able to adjust your own mindset and your own way of doing things to that local culture. That was, besides obviously the land, and I did all that without really, speaking any of those languages, which is kind of odd. I think at the end of the day, I think now it's very different with the amount of students and kids, younger people speaking more than one language. That's become a lot more common, and you also have quite a bit of non-US students that have come to the US to study, and so English has become more prevalent on that side. It's kind of changed that landscape even in the last 25 years. So that's a big open-ended question. I mean, there's a lot of differences, but I think culture would be the one I'd sort of settle on, and how it impacts doing business at the end of the day.
Appreciate it. Kui, I think would be really fun before we get into LaSalle, is I'd love to talk a little bit about the Lehman Brothers bankruptcy, knowing that you were co-heading real estate in Asia during that time. Would you be able to talk a little bit about some of your experiences? What was that like for you? I think we'd love to know a little bit about what was happening internally.
Oh, and during that time, look, there's so many books on it, and there's been, a couple movies, and I've yet to see the play about Lehman that's out there. It's probably all pretty good. You should just watch all of those. I mean, how do you summarize that experience? I would say for us that were in the bank, we kind of knew, it was kind of that of knowing that you were on a train that was about to wreck. Basically, we had the feeling months before the actual bankruptcy that that's probably where we're going to end up, but we didn't have any idea in terms of the timing and kind of how fast it sort of accelerated. I think most of us thought we'd get through 2008, and maybe it'd be in kind of 2009, but we got to September 15th, 2008. So there was a sort of awareness of the whole thing. I mean, some of this kind of, a lot of it did come down to sort of the relationship between Dick Fold at the time and Paulson, who was the Treasury Secretary. And one side thinking that the Treasury, would probably come and bail out Lehman Brothers as it kind of had orchestrated a Bear Stearns bailout. So I think there's just a lot of misanalysis or bad judgment on our part, actually, inside the bank, that we thought that there was going to be another solution to this. And we probably got started too late on solving the problem ourselves. And what I mean by that, a few months before, early in 2008, we had started talking to the SEC about this idea of really splitting Lehman into kind of a good bank and bad bank, which is the logical way when you solve these situations where you might have, a whole bunch of assets that aren't worth a lot of money, at the moment, and you separate those two. But there's a lot of bureaucracy, accounting, transfer requirements, X, Y, Z. But we had that concept of doing that. We just, I'd say, started that way too late to get that into the actual markets in time. If we would have started that earlier, you wonder if we would have ended up, if Lehman would have ended up in the same place. So I guess there's, the lesson to me in that for people is you really have to be honest and self-aware about your own situation, no matter how bad it may seem, versus trying to kind of either wait it out, assume you're going to get bailed out by a Hail Mary or something else. I mean, if like I said when I started this, we kind of knew we were in a bad spot, but we didn't really start early enough to really accept that and kind of do something proactively on it to control our own destiny. Which the irony in that whole thing is Lehman Brothers at the time probably had the best real estate investment banking business on the street from an advisory perspective. So we theoretically had the best real estate advisors, and we couldn't even advise ourselves, right, what to do to get out of this. So, I mean, that's sort of, it's not really a story, it's kind of a context. I mean, the stories, we can go on hours, just watch the movie.
One thing I just want to mention, because it's kind of like a funny fun fact talking about Lehman. So this semester we had 10 guest speakers total. You're closing us out, right? We're very excited for this one. But 3 of our 10 speakers all played a role in Archstone. So just want to mention this. So you were a buyer, right? Lehman. Yeah. Then we had Owen Thomas, who comes in. He's now the CEO of Boston Properties. He chairs Lehman's board, and he helped with the disposition of Archstone. And then guess who bought it? Sam Zell, who was so it was very funny, just showing his small world.
So the error on Archstone. Okay, there's a couple of things on Archstone. We'll hit this because I'm going to clarify this for you guys. Archstone as an investment thesis made total sense. And Mark Walsh's thesis with Archstone was multifamily in the urban core cities where land is constrained over the next 10, 15 years is going to be a home run. And I should pay up for that now because I think it's going to be worth a lot more in the future. That was the thesis. And the thesis was correct. And the valuation at the time when we bought it was peak valuation, right? To take it private. We had outs on that particular deal. We could have gotten out of it, and we talked about that late in 2007 before it had to close. But in order to out, because it was a public to private, there was a $400 million break fee. And I think Walsh, who was running global real estate for Lehman at the time, I think he would have paid that break fee and absorbed it within the bank. Because, I mean, it just, things were just not looking good at the end of 2007. But I think, the more senior management above him didn't really want to do that, and it wasn't so much the 400 million. I mean, Lehman could have absorbed a $400 million hit at that point. It was more just kind of the arrogance of the whole thing of not wanting to kind of back out. It was sort of this bravado that that's not what Lehman does. We don't back out of these deals, XYZ. And they went on with it. Okay, so you had that. When you fast forward the whole thing, at the end of the day, the thesis was 100% right. And in Archstone today is definitely worth a lot more than what it was when Lehman bought it in 2007. And even when it worked through the bankruptcy over years, it wasn't a big net loss to the creditors of Lehman at the end of the day. But it's an interesting one. It definitely was the deal at that point in time that kind of put us over the top, because we were adding, the optics of it was we were adding a ton of risk basically at the wrong time. Forget about the actual metrics of the underlying deal. The underlying deal was not a bad deal. The thesis on a long-term basis was the right thesis, but just bad timing.
Yeah.
Anyhow.
Yeah, timing's everything. Unfortunately, in some situations, it's made a very crazy impact on some of our transactions as well. But let's talk a little bit about LaSalle now. I think that would be fun, more at your current firm. So how did you get the opportunity to join back in 2010?
I'd known some Jack Chandler, who ran LaSalle at the time. And I was just kind of curious about that platform. They weren't really a competitor of ours when I was at Lehman, but they obviously were a pretty well-established private equity business. They were regional. They had a pretty strong footprint in Japan. And I just reached out to them just to see what is going on with them in 2010. Because now, if you remember, in 2010, you're still working through your portfolio, right? You're still trying to hold on to assets, try to recover as much capital as you can back on all the valuation declines, post 2008 with the crisis. So you're very much in a defensive mode in 2010 still. And LaSalle had a large Asia opportunistic fund that they still had some capital to deploy in, which, that was a really good vintage in 2010 to buy. And when you look at it in hindsight, it's pretty much buy anything. It wouldn't have really mattered what you bought. So just through those conversations, they were actually looking for someone to be a CIO for that platform. And I felt with my regional experience, it was a good fit. And, it's really over a couple conversations, I ended up joining.
Appreciate it. And kind of moving on to staying with LaSalle, but of course, everyone wants to talk a little bit about the impacts of COVID-19 and what you've been doing. And let's first talk about the beginning of this journey. So when COVID-19 was first becoming the reality, what are some of the actions that LaSalle took to better protect its stakeholders and maybe some of its holdings?
Yeah, I mean, look, there was a huge physical effort, I'd say, on the asset management side of the business, right? Getting in touch with tenants, just the basics of rent collection, who's paying, who's not paying. I mean, now if you think about it, that was an incredible change in just the operational side of the business, right? Everything was going fine for years, and all of a sudden you have a bunch of tenants like stop paying. And there's a lot of differences depending on what country. In some countries, it actually, the law was much more on the tenant side than on the landlord side. So there's all kinds of nuance and understanding. How do you deal with that situation on a tenant by tenant basis? From the investment side, I mean, it's interesting. We kind of knew about this early because we had a logistics development building in Wuhan, okay, in the epicenter of this. And so Wuhan went into shutdown in January of 20. So we knew right away that something was happening. What we underestimated was, I mean, based on prior kind of Asian epidemic kind of experiences, is we underestimated the contagion of it. I mean, I think we pretty much felt that the Chinese government would be pretty good on containing it, and based on prior history, but that obviously was wrong, and it kind of spread a lot faster than we thought. So we knew about it early. I wouldn't say we reacted incredibly quickly in January. We definitely slowed down our acquisitions starting in that point. As you know, in real estate, it was so interesting. It's not like buying a stock, right? I mean, once you identify a building, I mean, it could take you 60 to 90 days until you actually buy it, right? So it's not this sort of daily, you switch, gears immediately. But we definitely started slowing down. And so as it kind of rolled out, it became clear that obviously this thing was going to have a major impact. And I'd say in March, by February, March, we started effectively backing out of deals that we had kind of tied up, or we tried to renegotiate the price based on the changed circumstances. But I would say most of the, sellers really didn't want to accept a price discount at that point in time. So a lot of the deals just sort of fell apart, I'd say February, March of 20. So that's probably the best way we protected our investors, is that, we made in real estate timeline, a relatively quick turn in terms of not buying, anything for a little while, and starting to think through how it was going to impact the markets. On the flip side, we had some deals for sale that were tied up with deposits that needed to close in March or April. And frankly, I was surprised that those transactions actually went through and closed. So it just shows you how inefficient, perhaps, or bifurcated the real estate markets could be, right? We're not buying anything. And then there's still people that are still buying.
Yeah.
Okay. And there were people that are also buying in, kind of at the bottom in March and April. And that's all fine. But in only history will tell you if they're right or wrong. Because, at what price did they buy at that point in the site? We wanted a deeper discount for what we thought was going to be a prolonged experience. And I'd say at that time, the market was not giving you a deep discount on the private side. And the markets they've kind of turned out to be right? Because now you fast forward, values have generally kind of come up. The other thing we quickly honed on to was that we thought that countries that had a much better plan for the pandemic would do a lot better. That was a thesis we put out, very, very early, in February and March. And so that did lead us to at least continuing to look and try to find opportunities in the Asian countries, whether it was a Singapore or a Hong Kong, to a lesser extent, Japan and Australia. So we had this kind of macro thesis that where the governments kind of have their act together, you can come back into those markets a lot faster. That's proven to be true. So China, for instance, we were able to buy some assets on a discounted price, I'd say between April and June of 20, and that market just zoomed back very, very quickly in China. So that proved out to be. So those are kind of the things I'd say we did. Some of it very practical and some of it kind of macro thesis oriented.
And how has it affected some of your return profiles?
That goes now to how your portfolio was broadly positioned, right? Because if you were concentrated, overweight, retail and hotel, you got a problem, right? Yeah. I mean, you don't have to be a rocket scientist, but you got an issue. If you're overweight logistics distribution, you're fine. And multifamily, you're fine. If you're overweight office, questionable, right? Depends what it is, where it is, who your tenant profile is. So it's a mixed bag on what does it mean. When you roll it all up, if you use the public markets as a proxy for the values, there was some quick volatility, but it sprang back up pretty fast too in the public side. And net valuations are not really off that much at this moment. You probably heard it before, but basically what the pandemic did was accelerate certain trends that were already there, especially for retail and especially for logistics distribution. It did throw a complete shadow on office, I would say, where everybody is somewhat confused about the work from home impact on that. And I'd be interested to hear some of your all's view on how you guys feel about whether work for home or being in an office, has a lot of value. But there is confusion, I'd say, in the office space where that really plays out at the end of the day. So a lot of bifurcation, a lot of volatility, not a ton of discounting on pricing, because in the private market, it effectively froze and there weren't a lot of transactions. Yet, as you know, there's a ton of liquidity in the space. And that's why I started this comment out that this cycle is very, very different. Usually you have a crisis, a liquidity crisis, where there's just no money, then the asset values come down. That's not the case. You actually have fundamental disruption in the use of real estate, but you got a ton of money sitting around and it needs to get invested. Therefore, a floor on these assets, not as much discounting as you would think. It'd be interesting to see how it plays out 10 years from now.
Yeah, well said, much appreciated. And let's move away from real estate in itself now. I think we do like to touch upon leadership as well in ESG. So how important is organizational behavior for the success of a company? And what's the company culture like at LaSalle?
Look, you guys are studying that in school. Of course it's important. I mean, the culture can be a differentiating factor for these companies. I mean, I think it's quite, there's so much competition and it's so efficient in every space that you look at that you can default to culture as kind of a differentiator at the end of the day. In terms of LaSalle, I mean, how I describe the culture, I mean, first of all, we're real estate specialists, right? That's all we do. We don't have other asset classes like a lot of the other large money managers, right? We're not in equities, we're not in fixed income, we're not even in infrastructure. We're just in real estate. So that's one thing. It's sort of a very property oriented culture. We're global, right? So we've got 900 people in 25 offices. I mean, that's also part of the culture. And ultimately, what I'm trying to do in terms of my new role is really bring on better alignment between the individuals and the actual investment products that we manage, right, on behalf of other investors. So usually a general partner like ourselves might have somewhere from 2 to 3% of the equity in a given fund or in a given product. And that usually comes from a corporate kind of balance sheet. We're trying to move some of that so that individuals are putting their own money, individual employees are putting their own money in those same products. And I think to us, that's really the best way to get alignment and also create a certain culture, which is really about an investment mindset at the end of the day. Because if you have your own money in the deal, you're going to make decisions, right, that are kind of based on that, and that's in alignment with all your limited partners. So, we're specialists, we're global, we're diverse. People describe us as kind of collegiate, which is sort of a strange description for our brand, but we're sort of thought of having that kind of feel to it. A lot more collaborative, probably, but trying to inject a little bit more investor mindset throughout the entire organization.
Thank you. And you being the global CEO now, could you kind of talk about some of the most important attributes, in your opinion, to be a successful leader? And also, so what are some of the greatest challenges in leading a global company like LaSalle?
Look, you can read all these books about
Yeah.
what successful leadership. It's one of those things that it's really hard to put a circle around what it is. It's one of those things that I think you kind of know it when you see it, what good leadership really is. And when you try to break it down, it can go in a lot of different directions. Having said that, there are a couple of things I think that are important. There's no question having a clear purpose and vision for what you're trying to do and whatever it is. And it cannot be a vision purely based on measurable economic outputs. That's not a mission, right? That's a goal or an outcome that you want to get. So you have to have a bigger picture approach, to kind of have strong leadership. You got to be willing to listen. You got to be willing to take on diverse opinions, even if you don't agree with them and you think they're an absolute waste of time. You still have to listen to it. And lastly, I think good leadership is authentic at the end of the day. And in authenticity, right, you have a whole bunch of things: trust, empathy, all those kind of considerations that you sort of, read about in the textbooks. It's one thing to read about, it's another thing to actually see it in action. So if I had to break down the good leadership, that's kind of how I look at it, from that. Challenges, I think there's a lot of challenges. I mean, with the advent of technology, right? There's so much more information out there, right? There's so much more real-time information. Decision making can get sort of warped with all the different information streams that are out there. So how do you sort of stay focused on all of that? I think that's a challenge. I think, managing diverse communities is a challenge. I mean, can you really make everybody happy all of the time? Pretty hard to do, right? You got to hit most of the time. But that's a challenge still, notwithstanding anything. And lastly, any industry you're going into is competitive, right? There isn't anything that's not competitive. So you have that. And then lastly, especially for us in real estate, as I open this, we're one of those, one of the last large industries, when you think about it, that hasn't really been disrupted by technology, right? And so is that going to happen? How is that going to happen? When is it going to happen? That's kind of out there. That is it. When you ask me that is a challenge in my daily business, because people keep asking us, why wouldn't some robot with a good algorithm do what you're doing right now? All you're really doing is picking a property. I mean, look, there's some truth to that. I think there's truth to that. I don't know how it exactly plays out. So those are kind of where I see the challenges on the leadership side.
No, I appreciate that. And let's wrap up with some ESG as well, so we kind of have some well-rounded things to touch upon. This is obviously a big one. Schools are really getting heavy on this as well. It's becoming more and more apparent when you look at major corporations' websites. All the homepages are always talking about ESG. Investors are really valuing it more and more now. So how ingrained are ESG principles in LaSalle's operations and culture?
They're getting more ingrained. Okay. I would say, we weren't super early onto that story, but it's definitely picking up a lot of momentum. There's two ways to go about this ESG story. One is you can start implementing it into your portfolio on a building by building basis with some, fairly simplistic things, right? Energy improvement, things of that nature. The bigger question is there actually an investment theme that's out there that's completely focused on ESG as an investment theme? And are there investors that, in my mind, if they're so believing in ESG as a value proposition, they ought to be willing to take lower returns in order to invest in an ESG product? Okay. And we don't know if that is the momentum right now, I would say, from also the investment community, and they're saying that, but I don't think anyone's put a product out in front of them and said, listen, we're going to do an ESG investment strategy, in strategy A, and the exact kind of similar strategy over here, B, would actually make you some more money, but A is kind of a better thing to do, as we all know. Are you still, where are you putting your money? Are you putting it in A or B? Are you doing both? Are you splitting it? What are you doing? I don't think that's been tested yet. If people are willing to put their money where their mouth is, exactly. If they do, I suspect if they do, and I think they will ultimately, that's going to be a big segment. And I think for you guys studying it at the moment or in that area, it's a worthwhile area to get technical expertise on, because I'll tell you, I don't think anybody knows what they're doing necessarily in this space. There's bits and pieces of it. There's technology companies out there trying to come up with, better diagnostics. I mean, this is how arcane it is. You don't even know what you got. You don't even know what you're measuring to even know what are you improving in the context of a net zero, pathway fund. So it's a little bit like the wild, wild west in this sector. But it's definitely picked up incredible momentum across the board for real estate specifically. So definitely an area of, if it's of real interest to people, I would double down on it.
Thank you. I think now could be a good time to open it up for some live audience questions as well. I know many must be eager.
You got one question in the chat here. It says, did the money for that come from the government? Which I'm getting old. Remind me what I said. What are we talking about? This is from Ariel.
You were talking about liquidity and how it wasn't a problem in the pandemic.
Oh. Yeah, I mean, ultimately it does. It either comes from the government or it comes from crypto, right? One of the two sources. Maybe those two things are the same thing. No, I'm just kidding. It comes there's government money there, but it's also just the amount of money that's in the investing markets, right? Whether it's individuals, high net worth individuals, pension funds, sovereign funds, the amount of capital that's available for investment in the world, broadly speaking. I mean, I don't know what the exact stat is, but it's definitely up dramatically over the last 10 years. And ultimately it does come back to the government in terms of, supply of M2 has definitely gone up a lot over the last right. 5 years.
So, Mark, someone from, again, Northeastern, one of your favorite schools, He had a question. Will, do you want to ask, or should I ask what you chatted me?
No, I can go ahead. Hi,
Awesome,
Mark.
awesome.
Will from Northeastern University Real Estate Club. A lot of great stuff. I got a lot of family over in commercial real estate. I'm actually in China. So right now there are folks mainly in the Pudong area. So if you know, like Shanghai, all the way extending over to Midwest in Chongqing down there. So they're doing a lot of basically land purchasing and extending, creating the first high-speed railway systems out there. So I just wanted to get to know JLL a tiny bit more. You mentioned some work in Japan, of course, but hearing bits and pieces of China and stuff, I'm hearing a lot of different things going on about Taiwanese semiconductor, with a large drought and stuff like that. Wondering if that's affecting any international land deals you have going on over there. Love to hear about the portfolio.
Yeah, so there's two things there. There's JLL that runs a very big real estate property services business in China. I want to say they have something like 15 to 20,000 employees in China doing things like property management, leasing, brokerage, XYZ. And then there's LaSalle and what we do. And the product we honed in on in China that we've been investing in since 2007 has been the development of logistics or distribution buildings. And that's been a great play given the rise of e-commerce and all the shift to domestic consumption, right, in the Chinese markets in general. And that market, as I mentioned earlier, recovered really, really fast on the real estate side in 2020. It was a very short blip where it kind of went down. Overall, we are pretty constructive of our forward view on China. I mean, there's a lot of regulatory and other things you have to structure around and understand, but fundamentally, that is a good market to invest in for commercial real estate. And you mentioned the trains and the high-speed trains. I mean, anything that's an infrastructure related play in a growing market is likely going to be a good investment. It doesn't mean you can't lose money doing it, but the big thesis makes a lot of sense. And we subscribe to that. The way we've played it has almost been exclusively industrial. We've done a little bit of office in Shanghai, which, we leased a bunch of it to WeWork, so that didn't work out so well, but we replaced them already. But we're mostly industrial in China. And I think the growth is going to continue over there. And I think China has a very determined long-term plan, right, from an economic perspective. And because they have a long-term view, I think they will be able to control volatility that occurs either in their markets or the global markets, probably a lot better than a lot of the other countries at the end of the day. So I don't know. I mean, we're positive that I mean, we're actually raising this China logistics fund right now, and it's been put on JP Morgan's high net worth investment, platform, and it's getting really strong response from US investors. So that also tells you, right? That's telling you something that China is not for everyone as an investment thesis, but there's plenty of capital out there that's investing coming cross-border into China.
No, awesome. That answers my question perfectly. Thank you.
Great question, Will. Let me see who else is in first come first. I want to do it in order to be respectful. So Trevor, go for it.
Yeah, hi, Mark. Thanks a lot for taking the time to speak to us. And the question I had was in regard to the time you spent in Japan. One of the things I heard about the Japanese market is that there's a big barrier to entry from foreign companies in investing in a market where the general consensus is more towards like the domestic Japanese firm. Did LaSalle experience any of that in building their portfolio in Japan? Or, and obviously correct me if I'm wrong, if that's not correct information.
Look, there's a little bit of that, listen, if a BU student walks onto Harvard's campus, is there a little bit of an outsider wearing a BU sweatshirt? Do you get a little bizarre vibe over there? Probably. I mean, I think it's similar. I don't think it's anything systemic over there in terms of not being able to penetrate that market. It doesn't have some of the protectionist policies that you might see in other markets like a China, for instance. So I do think the barriers are not purposeful, but that doesn't mean there aren't barriers to enter into that market. As I mentioned earlier, I mean, the Japanese culture is the Japanese culture. And if you're an American company or a German company trying to launch a product into that market, culture plays a big difference. It doesn't mean the product you've designed for your home market is necessarily going to have adoption into that market. And I think a lot of people do think products that they've designed outside of a home market will have adoption. And that's not necessarily, I'd say, the case. So I think the barrier is a kind of a deeper psychological understanding of that culture and what it means into whatever market you're playing into. I'll give you an example. So adoption of robots in the daily use. I will bet you Japan, for a variety of reasons, will have a high adoption rate of robots in their day-to-day. They already have started it in some way. And so because it pops up in other parts of the culture, right, this fascination with kind of automation and sort of virtual environments translates into some other kind of product lines that are possibly not coming directly from Japan. So that's how I would kind of look at that. Did we have any challenges? I mean, yeah, I think we had the sort of early challenges of being a foreigner in a country that we didn't really know. And so we didn't have the relationships, right, between a lot of the big banks. But I tell you what, if you fast forward now 20 years, we as, LaSalle, our relationships will never be as good as the Japanese companies that have been doing business for hundreds of years together. But we've made a lot of headway, and I wouldn't say it's a competitive disadvantage to us. We've been able to kind of get more into the market and into the culture, but it's taken time. So I think the other place where a lot of commercial ventures flare out is they don't have the time to invest into that market because things do move a little slower in order to build those relationships. They want to get in, get out, make the money, take off. That's not going to fly in that particular culture. So those would be the barriers that I would see. I think if you have patience with that market, it's an interesting market. There's a lot of opportunity over there, notwithstanding what you read about declining demographics, in Japan. I wouldn't write those off. I mean, I think there's a lot of opportunity over there.
Yeah, thank you very much.
Pranay.
Hi, Mr. Mark. It's been great hearing from you today. Thank you so much for joining us today and giving us your valuable contribution. So my question was related to you joined LaSalle about 10 years ago, and your timing of joining is somewhat synonymous with the exponential growth of LaSalle as they've grown quite a bit over the past 10 years. So what would you say are the changes that you've brought in, and what do you think are the major factors that contributed to the success, not only of yourself, but also the company?
Well, I mean, look, I think, it's interesting. You guys probably go through this when you're looking at some of your, market-oriented classes. You can make numbers do whatever they want them to do. Have we grown in the last 10 years? Yes, we have grown. Have we grown pretty strongly? Yeah, on certain metrics, you can count that. Did we outperform the market over the last 10 years? Now, it depends how you define our market and who was our competitive set. But I would say we haven't outgrown the market. There's been some folks that have grown a lot faster than we have. So I appreciate the compliment. But I'm sort of 50-50 on it, whether we've really kind of grown dramatically. There are some places that we have grown dramatically, and that was, broadly in Asia. And I think what drove that is kind of what I mentioned about leadership. It's sort of starting, with kind of a mission that then translates into some very specific goals, which are usually tied to market opportunities, and then being able to execute in those areas. So, we were early movers in logistics, as I mentioned, in China. We were even earlier movers in logistics in Japan, going back to 2004. We knew that was a good business, and, we just kind of kept focusing on that and really growing it. And that did grow much faster than market. And then the other change I'd say I made was trying to bring around this investor mindset into the population, and usually around these employee co-invest loans, which is a way for an employee to invest into a product, right? Usually that was reserved for the very senior members of the firm. It wasn't really pushed down the organization into more junior kind of members. And we can't push it all the way down to analyst level because of accreditation issues, right? You can't just, but we can move it down to sort of VP level, people in their late 20s to be able to put their own money into the transactions. That was different. That's an innovation that not a lot of firms really have. They tend to keep it at the managing director or senior managing director level. And I kind of feel like that's not really fair at the end of the day. You guys don't want to work for, 20 years and be a managing director and then get that perk. Why not get that perk now? Why not be able to put your own money in some of the things you're working on right now? So besides for regulatory reasons, we kind of are opening that program. I think that had something to do with it definitely had something to do with retention for us. We do not get a lot of turnover, I'd say, relative to our competitive set. So people are staying within our organization longer. And I think that's one of the reasons, not the only reason, but that's one of them. So hopefully that answered your question around what were sort of the drivers. I still feel we got a lot to do in our space, but it's off a really good foundation.
Awesome. Thank you so much. That's great to hear. And as Jeff Bezos always says, it's always day one, and there's always much more to grow.
Well said by the largest, wealthiest guy in the world. All right.
Oh man. So Oliver, go ahead.
Yeah, awesome. Well, Mark, I just want to start off and thank you again for taking time to speak today. This whole event has been super insightful, so very much appreciated. I had a question regarding LaSalle's sustainability initiatives to kind of reduce the carbon emissions. I know there's been a big initiative for a lot of these corporate commercial real estate firms to invest and manage buildings that do have a much more like green label on them. Do you see kind of this happening with LaSalle, and how do you think like the long-term projections of the like investments might change as this like initiative might gain some more momentum?
Mm-hmm. Yeah, so it's definitely a focus for us. So for instance, we do have a global head of sustainability. So that's a dedicated position. We then have regional people that are heads of sustainability. So what they're doing right now is they're looking at our existing portfolio of buildings that we own. And if we can put them on a pathway to become, let's just call it a green building from a labeled perspective, we'll do that. Even if we can't get them labeled green because it's just the way they are, there are still some low-hanging fruit that you can do that you could show that you're reducing the carbon footprint on those particular buildings. So those become very building by building initiatives, right? Do you put solar panels on that building? And like I mentioned before, you actually have to measure. You got to get a whole new measuring approach to even understand where you are on, if you're trying to go to a net zero pathway footprint of a building, there's a lot you have to do from a data perspective to even know where your building sits on that. And then you can start coming up with a plan of what are the specific things you can do to improve that curve line. So we're doing all of that. Part of it is our investors are requiring us to do that. They want to see that measurable data in the buildings as part of our reporting that we're doing. Part of it, you're starting to see that it could increase the value of your building if you're already labeled a green building or you're heading in that direction. It does seem to have, it's hard to prove, but it feels like it's got more value in the buildings. And that's generally coming, I'd say, more from the office space. You do have certain tenants, corporates, that are saying, we will only rent space in certain buildings that have this kind of, ESG overlay. So that's material. Like if you can't rent your building, you got a problem. So that's, those things are happening. Where does it play out? I think it plays out where certain building owners, if they don't get into this diagnostic side of it to understand where their building sits, and depending what regulatory environment they sit in, one that has either high focus on this or low focus. Like New York City is a good example, high focus on this right now. You don't do anything, there's a chance in 5 years from now, your building's actually legally uninhabitable. Like the laws won't let you go ahead and rent it out and use it. So you go from a building that was functioning fine to basically an obsolete building. Now that's a pretty big delta, right? In value. That's going to get people thinking like, oh, I better do something. I better at least put it on the pathway, right? So I'm showing that I'm doing something, but different people will move different speeds on that path. We have made a firm, JLL, our parent company, has made a big commitment to implementing those kind of initiatives across all their clients. You know, their clients are corporations, other people. For us is, you know, we manage or own the buildings or invest in these buildings on behalf of our investors. And we are doing these things, you know, at the asset level today in terms of improving it. So as I said, I think unless the regulatory regime changes, right, and you don't have these requirements, ESG is going to be a big area and a big investment and, you know, growth and job opportunity, broadly speaking, in this space.
Yeah, no, that was super insightful. I'm actually joining JLL this summer, and I know a big initiative from them and like my employers, they kept on mentioning this whole sustainability movement. So
it's big. Listen, you know, it's huge. I think, like I said earlier, I don't think a lot of people really know what they're talking about when they're talking about this. It's one of those things that kind of sounds really good, but like, what is it at the end of the day? Because it's got to go beyond just switching out light bulbs. Like that's not enough, okay? Or putting some solar panels on a roof. That's now you're starting to get into facades, you know, materials that are used, like actually building a building, you know, unless you're using all green kind of oriented materials, actually building a new building is worse than retrofitting an old building. So there's a lot of, you know, things that need to get worked out. You know, we're going to need smart people like yourselves to go ahead and figure out all that stuff. It's way beyond my lifetime. But anyhow, keep shooting. I'm happy to keep going a few minutes over if you guys want to.
Cool. Why don't you go ahead?
All right. First off, thank you so much, Mark. I've learned a lot today, especially about how real estate is becoming a more global business as capital becomes more available. I know you talked a lot about Asia, but I was kind of curious. I know LaSalle is somewhat invested in Europe's market, so I was hoping you could tell us a little bit more information about that.
Yeah, look, LaSalle, we are probably about sort of like a third US, a third Europe, but not exactly a third Asia, but we're somewhere in that area. I mean, Europe and the US are two big markets for us. Actually, when you think about Jones Lang LaSalle and when they started, it was really Jones Lang back in the UK about 250 years ago. So it's actually a very old company with big UK roots. At the end, if you ever heard of Jones Lang Wooten, that was the American version of it until all these mergers. So we do have a business in Europe, based in London, but we've got big offices in Paris and Munich. We're investing across all the different asset classes, you know, multifamily, office, industrial, some retail here and there. The market's a lot slower there, I'd say, at the moment. And it goes back to kind of, you know, how have you dealt with the pandemic? And Europe is still kind of working its way through there, right? It's not as fast on the vaccine take up as we have been in the US, but getting faster. You know, travel hasn't really opened up yet, but a little bit has. So the European markets, you know, I think are still they're definitely investable. And when you're a global investor, right, you're always going to have a European allocation. But then how you place it in Europe might come in a lot of different ways. Are you more UK? Are you more continent? Are you going Eastern Europe? Are you going to the southern countries? You know, there's a lot of different ways you can slice it. I would say recently we've probably been buying a lot more in the Netherlands. There's been some more activity for us there. We've got a large presence in the UK. We think the post-Brexit situation is going to be actually a good investment opportunity into England, broadly speaking. It's more specifically London. So I do think that, you know, we'll be looking to do more transactions there. So it's an important part of our business. And it has all the same cultural dynamics and things that I talked about before, right? I mean, the UK is not Germany, and Germany is not Spain, and Spain's not Italy, although some of them have a common currency.
Thank you very much. I really appreciate it.
Keep shooting. I'm happy to go answer some more questions. You guys want to keep targeting them? Anything you got on your minds? Anything you want to sort of hear about, whether it's career or elsewhere? I'm happy to answer.
So I know you are in Hong Kong. One question that I would love to ask, if you're comfortable answering, it's not really about politics, but there's been a lot of talks about the Biden administration and long-term capital gains taxes. If somehow this was to become a reality where this will be removed, and that's going to almost double, right? That 20% cap's going to be almost 38% or 39 if he moves that bracket too. What's your opinion on the true impacts here? Because I know there's two sides or two opposite perspectives as to what could come out of this. Some say it's positive, some say it's negative. I have my personal beliefs, but it'd be great to hear yours.
I think it's going to happen. A broad subset of it. I think it needs to happen. I think it makes a lot of sense as an effort to redistribute it. I mean, the knock you get is, okay, raising taxes is just one part of the equation. How you distribute it back into the economy is another one. So it's only the first leg of that. Is it a good thing or is it a bad thing? Very hard to say if it's a good thing or a bad thing, because it's just the beginning, right? It needs to. And look, if those taxes are used just to, kind of pay the interest on the debt, it's not really creating a lot of marginal utility, right? If it's used to be invested into infrastructure, something else. And it's kind of like the real estate question. It was Ariel that asked me, like, what's the driver? There is no real driver here on this. So I think it's got to happen. I think it will spur a lot of mobility around people individually trying to arbitrage taxes, is what I think a net effect of it will be. And it's already happened. You've already read about hedge fund folks and PE folks moving to Florida or to Dallas, Texas. Like, you can't tell me they just want to go live there because they really love both those places, right? They don't. They're just moving there so that they can, hedge against this likely tax outcome. So you are going to get some mobility out of that. So like anything, I think there will be, when you look at it from a city perspective, there may be some winners and losers. You could have a thematic investment thesis just based on that, which you've already seen that playing out in terms of, if you think of the hottest multifamily markets in the US at the moment, a bunch of them are in Florida and a bunch of them are in Texas. Now, why is that? Anyhow, that's my sense on that. It needs to happen. It probably will happen.
Awesome. Let's wrap this up fairly soon. I think we're kind of coming to the end here. It's been just over an hour, but Pranay, you have another question? Feel free.
Yeah, I have one last question, and this is related to office spaces. With the very public disaster of WeWork and it losing 90% of its value from its IPO, and like a lot of companies also going online till at least 2024, what do you see the future of office spaces looking like? And do you think that there's a future for shared office spaces as well?
I think there's definitely a future for shared office space. The WeWork thing's interesting. I don't think the idea was that bad. Okay. I think the execution in the capital stack and the way they managed, they're basically too greedy at the end of the day. If they would have tried to IPO at a more reasonable valuation, they would have gotten the deal done. So there is something in their value proposition, a flexible or shared space. And you can see there's a lot of other smaller competitors that have moved into that space. So it does make sense. So I do think there is a market. There is a market for that. Were they going to revolutionize the world? I don't think so. Was there some bad metrics in the way they locked themselves into long-term leases, but then we're selling short-term memberships to people? That's a problem. That's a fundamental, right, duration mismatch. So there's some issues in their model, but the concept is valid. You're asking basically what everybody's debating, at least in the US and Europe, not an issue in Asia. Return to office is pretty much the story in Asia for some of the reasons I talked about the governments handling the pandemic better. but it is a question in the other two markets. You know, you're not going to have the answer to it, but our research is saying it is probably a fundamental hit to demand, you know, in the 5% to 10% range. So there is going to be an impact to as companies work through the work from home perspective. But I don't think people are going to go away from the office, broadly speaking. I think also for your all's generation, as much as you're technology oriented and instant communication, you can't really replace the power of kind of proximity, of being near people, right? Whether it's people your own age or, you know, other folks. I mean, that is another way of learning, right? Or collaboration. It can't 100% be done virtually like we're doing it right now. So that's why I'm a believer that it doesn't get a dramatic hit, but it does get a repurposing. And I think there will be, again, winners and losers around that. And it will take a few years to play out. I don't believe some of these companies can, even though they're saying they're letting people go 100% remote 100% of the time, I don't think that's sustainable. You know, at the end of the day, unless you want someone to put like a little chip in you and follow you around every single second to see how productive you really are at the end. And maybe that's where it ends up, because you could get to a point where everyone's input is highly measurable, right? And if you do that, then proximity and geography become less relevant. So there's a lot of powerful themes going on over there in office, but we're not proclaiming the office space is dead by any stretch of the imagination. Even in our own offices, we're taking a very kind of open-minded view to it. We're not asking people to come in for the rest of 21. We'll really look at it in 22, and we're willing to talk to people about changing locations, or if they want to go 2-3 days a week remote and only come in 1-2 days. You know, we're open to kind of customizing. And I think that's kind of where, you know, it's going to have a practical outcome, I think, at the end of the day, depending by industry and company. But it's a great question. It's one that's really being talked about quite a bit. I don't think anyone's got the answer to that one either. Did you cover everybody on this call, or that's it?
Yeah, I think everybody that was brave enough to ask a question or had a question gotta ask. Is that right? Right? Everybody did get a chance to ask who wanted to or was comfortable asking before I kick you all out. Just do raise your hand. This is your last call. I'm gonna give you 3 seconds. Going once, like as if we're at an auction right now.
Sure.
Going twice. All right, that's 3 times. We're
Good.
closed. So Mark, it's been an absolute pleasure. We really want to thank you for joining us tonight. We learned a lot. I really enjoyed our time with you, and we hope to have you back maybe sometime next year.
Happy to do that, and good luck with getting back to the routine over there. Hopefully, I'm in the fall. The college experience is more like it used to be. I mean, I know this last year and a half has just been a nightmare, really. But I think people are getting through it. So appreciate it, Michael, and I'm sure we'll be in touch.
Yeah, talk soon. Take care.
All right, thanks, guys.
Take care. Bye-bye.
Bye.